We had a gigantic week as it related to semiconductor stock news. Nvidia reported their earnings. I am going to show you something that very few people are talking about at the current time, but is likely going to drive Nvidia stock either much higher in the coming months or much lower, depending on which way it breaks in the coming months. So we'll talk about what that is. We had gigantic news from Super Micro Computer. Some of you may remember 4 months ago, not 4 weeks ago, not 4 days ago, 4 months ago, we called Super Micro Computer Company $150 trash. At the time, it was an $800 stock. Well, it was a brutal week for the company after Hindenburg Research unleashed a new short report on the company. It is a gigantic report. I'm not expecting you to read all like 20,000 words of this. I have taken out some of the highlights and we'll share those. Now, on the heels of that, the company announced that it is not going to be able to file its 10K, which is its annual report, on time. That is an absolute disaster, particularly for an S&P 500-based company and a company with a $25 billion market cap. We'll talk about the ramifications as it relates to Super Micro Computer. We've had Dell Technologies, which are certainly maybe a benefactor of Super Micro becoming $150 trash. We'll talk about Dell Computer as they reported their earnings. We've got big news out of Intel. I have confirmation that Pat Gelsinger is finally watching the investor channel and starting to take some of the advice that we've had with this company as the company is weighing options to potentially splitting out of its Foundry business, which many in the comment sections of my video said would never happen. Now it seems almost inevitable. We'll talk about some of the reasons why, and those reasons have been staring you right in the face every time you've opened up Intel's financial sheets. And then finally, we'll come over here and look at this technically. Big moves in the stock market, big moves in the semiconductor industry. So we've got to keep an eye on it from a price perspective. What is going on, everybody? Hopefully, guys are doing well out there. Let's not waste any time. We have a gigantic week. We obviously had Nvidia earnings, and those came out fantastic. Now, we're not going to go through them line by line, as I'm sure most of you have already seen the video that we posted on the main channel, or maybe other analysis, and many of you are opening up these financial sheets yourself and taking a look at the numbers. I'll highlight a few things in the financials that are certainly beneficial, but I'm going to be talking about something today as it relates to the revenue estimates for Nvidia that I don't see a lot of people talking about and is highly unusual, not in the stock market, but when we're talking about $2.9 trillion companies, when we're talking about the most liquid stock on a daily basis, Nvidia stock is actually the most actively traded stock. It's got a ton of eyeballs on it. So usually when that is the case, the estimates for this company's future, the projections for this company's future are typically in some type of alignment. But I'm going to show you, we've got wildly different expectations for Nvidia going forward, and those big gaps are going to create big price swings in Nvidia one way or another. Now, the Q2 came in and it was fantastic. $30 billion worth of revenue. If you want to rewind time and go back to our show last week, we talked about how the company has consistently added $4 billion to this total revenue line, more specifically the data center line, which is those high-end performance GPUs that they're selling into the data center. And I think the expectations were for $29 billion. And we said, no. NVIDIA is going to do over 30, and that's exactly what they did. Now, what drove the stock down just a little bit is their Q3 outlook was slightly underneath expectations, $32.5 billion. Sequentially, that would just be a $2.5 billion improvement, which again would deviate from what the company has been doing really over the past year in terms of total revenue. Now, you could not believe the company as they beat expectations by about $1.3 billion, but also the fact that the Blackwell chip has been delayed or pushed into the Q4 quarter, which carries over into the month of January. Well, some of this revenue that potentially was going to show up in Q3 will show up more likely in Q4, probably even more specifically Q1 of next year. But that's not really the big thing going on in NVIDIA. The big thing with NVIDIA is the expectations as we start to look forward into Q4, but more specifically Q1, Q2 of next year. And the reason why this is so important is let's just bring up AMD, a similar company to NVIDIA, obviously not identical, but a company with a lot of analyst eyeballs on it and a lot of attention on it. And AMD's revenue is obviously not anywhere close, or it's certainly 3 times, 4 times less than what NVIDIA is putting up. But I just want to show you this for an example as we look forward with revenue estimates. And some of you might say, well, revenue estimates really don't mean anything. Well, I'll remind you what kicked off the absolute blast off in NVIDIA stock and where you had the share price just rapidly start increasing was when NVIDIA started reporting revenue that was well above. We're talking $10 billion higher than what the expectations were. Any company, I don't care if it's NVIDIA or a dog manure company, when they start outperforming expectations, well, that is what drives the share price up almost better than anything that a company can possibly do. So revenue expectations are extremely important for companies. And typically with companies of this size, they're very similar. You look as we go out, let's just pick a random number here. Q2 of next year for AMD, analysts are expecting between $7 billion and $8.45 billion. So only about $1.5 billion gap. The midpoint of that is for 7.7. You look across the board for AMD over the next 6 quarters or so, most analysts are expecting anywhere between 7 and 8 billion, maybe 7 and 9 billion dollars worth of revenue. There's not a big gap between these numbers. That's what the expectations are for AMD. They're expected to meet these expectations. Certainly if AMD starts showing up in Q4, Q1 of next year, $10, $12 billion in revenue, well, AMD shares are going to hit all-time highs. It's virtually guaranteed if they happen to do that. Now, take a look at what we just talked about with AMD. Now I'm going to go to NVIDIA, and this is absolutely wild. I have not seen this actually in a long time in the stock market. The Q3 is relatively in line because we just got guidance from NVIDIA saying they're expecting $32.5 billion in revenue. Again, sequentially quarter over quarter. That's only, and I say only, $2.5 billion more than the previous quarter. When the previous 4 or 5 quarters, we've added much closer to $4 billion. So a little bit of a slowdown there. That's what NVIDIA is projecting, and you see analysts have caught up. The low-end estimate is for 32.5, which is exactly what NVIDIA guided to. The high-end estimate, which is probably closer to reality, is closer to $35 billion. But look as we stretch out into Q4. You have 32 to 43. That is a $10 billion gap. Look as you stretch into Q1 of next year. $34 billion is the low-end estimate. $45 billion is the high-end estimate. Look as you stretch into Q2. This is not that far away. We're only looking at 1 or 2 quarters forward. Look at this. $34 billion is the low end. $15 billion higher. Near $50 billion is the high-end estimate. Look at this. As you get into Q3 next year, we're not even looking like a year away. $32 billion is the low end. $56 billion is the high end. And look as you get into Q4 of next year, $25 billion is the low end. My guess is this analyst just hasn't updated this number. We'll maybe give NVIDIA credit for $40 billion on the low end. Look at the high end estimate. And again, there are 29 analysts covering this. We won't get when the numbers fall off. $80 billion is the high end estimate. Literally nobody has any idea where NVIDIA is going to fall on the revenue. When you see swings and spreads this wide, literally nobody has any idea which way NVIDIA is going to go just over the next couple of quarters. Look, 5 years from now, it's a question mark. We're talking 5 quarters from now. Nobody has any idea whether it's going to be 50 billion or 35 billion. That is a huge gap. And I tell you what, if NVIDIA can come close to these high-end estimates, not necessarily meeting them, but close to them, well, shares of NVIDIA are going to reach all-time highs again in the next couple of quarters. If they come to these low-end estimates, a lot of the doom and gloom scenarios of $100, $75, $50, those will likely come to fruition. I haven't seen anything like this in quite a while in the stock market, where you have this big of a gap in discrepancy between low and high-end estimates. Obviously, some of it has to do with Blackwell. Can they deliver it? Can they sell it in large volumes? Can TSM deliver from a capacity perspective? All of those types of things. But boy, you've got some big volatility heading for Nvidia. Shares really, obviously, over the past year have more or less gone straight up. I think you've got some bigger swings up and down, and those create opportunities depending on which way you side on this. If you think Nvidia is going to come up short, well, you absolutely want to avoid the stock. If you think they're going to come closer to these high-end estimates, these are buying opportunities when the shares drop. And after earnings this week, Nvidia shares slid by about 9%. I stepped in and bought Nvidia shares for no other reason other than you have these big gaps. And by all accounts from their top customers, Microsoft, Google, Amazon, Tesla, on and on and on, Meta, all of their top customers are saying they're going to continue to spend on the data center. And as long as they continue to say those types of things and prove it when they report their earnings, well, I think Nvidia's got a good shot at coming close to these high-end estimates. Now, the other thing with Nvidia is there's going to be a, quote, invisible bid underneath the stock. And the invisible bid is in the share buyback form for Nvidia, because you've seen over the past 6 months for Nvidia, they've produced a whopping $29 billion worth of operating cash flow. And this is also why, if you believe that this company is going to come close to these high-end estimates when it comes to revenue, well, these operating cash flow numbers are going to get even bigger and bigger. And unlike Intel, which is burning money in a fire pit trying to build fabricating facilities, Nvidia is not making that mistake. In fact, over the past year, they've spent, or over the past 6 months, they've only spent $1.4 billion on purchases of property, plant, and equipment. So this $29 billion has not a lot of places to go other than to repurchase common stock. You see, they spent about half of their operating cash flow over the past year to rebuy the stock of Nvidia. And you better believe, even if Nvidia comes closer to kind of the midpoint of these forward revenue estimates, or comes even closer to the low end estimates, they're going to still have massive amounts of operating cash flow that is going to allow them to buy back the stock. We've seen how that's worked for Apple, particularly over the past decade. Apple's results from a sales growth perspective haven't been very impressive, certainly over the past 2 or 3 years, maybe even stretch it back to about 5 years. But because the company is one of the biggest buyers of the stock, you almost don't even notice it. In fact, you have one of the largest shareholders, individual shareholders, Warren Buffett, dump the stock, and you barely noticed it. When it came to Apple, Nvidia, very confident they're going to be able to continue to meet their financial obligations. And the upside is, if these wide swings in revenue estimates, I challenge you, go find any mega cap company and try to find gaps as large as this, from not just a dollar perspective, but from a percentage perspective. It's hard pressed. Now, on the micro caps and the undercovered stocks, it certainly happens. But there's not many companies, as you look forward basically a year, where the revenue estimate is either 25 or $80 billion. And when you see things like that, that is when fundamental analysis can pay off. And I think with Nvidia, I think we can all agree their chances to come towards the high-end estimates are probably much greater than hitting the low-end estimates. Now, speaking of low are the investors in Supermicro. A lot of you probably piled into Supermicro because you watched CNBC, or you watch some of these idiots here on YouTube that really probably don't know much about Supermicro Computer. They certainly have never probably opened up the company's financials and never talked about it, but they basically heard from somebody else that Supermicro Computer was a company you should buy. So they made a video about Supermicro, and you piled in to this one at the top. Well, unfortunately, over the past 5 days, Supermicro Computer is down 28%. Over the past month, you are down 36%. Over the past 6 months, you are down 49%. And there's no one on earth that is less surprised by this than I am. because 4 months ago, we made our very first video on Supermicro Computer. At the time, shares of Supermicro Computer, I think, was an $858 stock. And I promptly called it $150 trash, referencing the stock price of where we're heading. Now, we're not quite at $150 yet, but we're certainly not anywhere close to $800 as shares of Supermicro after having one of the worst weeks that we've ever seen from a mega cap company, down to about $437 per share. Now, that's on the heels of Hindenburg Research. Hindenburg Research probably watches the channel because they got tipped off to this one a couple of months ago, probably right around the time that we told you this stock was an absolute disaster. Now, I certainly didn't do the research that Hindenburg Research did. They have a absolute scathing report on the company. Now, I'm going to save you a little time. You probably saw the press release of this one, but you didn't actually read the report. Now, I read the report, and we'll recap it here. But a lot of this report, and my guess, is that Hindenburg Research on August 27th came out with their short report. My guess is they were actually privy to, and they already knew that the very next day or sometime this last week, Supermicro was going to announce that they weren't going to file their 10K on time. They have people, employees at the company. They have internal access to the company. So they knew Supermicro was going to make this announcement that they weren't going to file their 10K on time. Now, I'm assuming this. This is not fact, but I am assuming this. So Hindenburg says, okay, on the 27th, we're going to drop this bomb. We're going to drop our big report because we know, again, later in the week, Supermicro is going to announce they're not going to announce their 10K on time, which is really, it's not unheard of. But for $25 billion companies that are a part of the S&P 500, it's extremely rare. This is extremely rare, and it's a big red flag. It's not just a red flag. It's like multiple flags waving in the air. Now, saving you the time to read through this report, I've summarized it for you. Now, this all, again, is credit to Hindenburg Research. And all of these quotes that I'm pulling from here are direct from the research, and I'll have a link down in the description below to this research. I don't want to make it seem like I'm trying to copy or piggyback off this company's research, although, again, one of the reasons why I am doing this is 4 months ago, well before this company's financial situation came to fruition, I made a video and posted it for free. In fact, the company I was working for at the time wanted me to recommend SMCI to our subscriber base, and instead I made a free video and probably made like $25 and told you it was $150 trash. And if you go to the comment section of that video, I get absolutely eviscerated. But now we are vindicated to a certain degree. Hindenburg Research said in 2018, this is all known by many investors at the time, that Supermicro was temporarily delisted from the NASDAQ for failing to file financial statements. Well, here we are several years later, and the company is failing to file their financial statements on time. Just 2 years after the initial violation by Supermicro in August of 2020, the company was charged by the SEC for widespread accounting violations. Folks, this was just 4 years ago, mainly related to $200 million in improperly recognized revenue and understated expenses, resulting in artificially elevated sales, earnings, and profit margins. Now, less than 3 months after paying a settlement in that 2022 allegations by the SEC, Supermicro Computer paid a $17.5 million settlement, and the company quickly began rehiring top executives that were directly involved in the accounting scandal per litigation records and interviews with former employees. So the company didn't file its financial statements on time. They were charged and found guilty by the SEC for widespread accounting violations by over-reporting revenue and profits. And those people that were responsible for that were promptly rehired at Supermicro Computer and currently still work there. Now, disclosed related party suppliers. A related party is somebody that the company does business with and maybe a sibling or a close relative of either the executive or a board of directors also runs that company. And what we've found is related party suppliers AVGO and CompuWare are controlled by Supermicro CEO, who's here pictured on the right. It's controlled by his brothers. and they have paid $983 million just in the past 3 years. So Super Microcomputer has two top suppliers called Abelcom and Compuware. It just so happens that both of those suppliers are owned by the CEO's brothers. And over just the past couple of years, $983 million has funneled out of SMCI into Abelcom and Compuware. And now it gets even more interesting than that. Abelcom is also partly owned, not just by the brothers, but by Supermicro's CEO and his wife. So isn't that interesting that Supermicrocomputer has a supplier, one of its top suppliers, that has funneled nearly $1 billion to over the past 3 years, and it just happens that that supplier is owned by the brothers of the CEO and also by the CEO himself and his wife. Do you think that supplier Abelcom is trying to negotiate the best prices in those situations? Do you think SMCI is out shopping for better pricing, maybe better terms from other suppliers? Or are they just going to Abelcom because it's owned by the brothers and it's owned by the CEOs, and they can recognize a lot of that as pure profit? Now, this is also very interesting. Supermicro's headquarters are in a science and technology park, and it just so happens Abelcom and Compuware, which are the two suppliers that are controlled by the brothers and the CEO and his wife, just happen to be virtually next door. Now, I understand this is likely in Taiwan or some other place where maybe geographically these types of things happen. Look, you have a lot of companies in Silicon Valley that are more or less next door as well, but this seems incredibly ironic that they are virtually next door. Now, the related parties seem to do little other business, so they basically only exist to be a Supermicrocomputer supplier. 99.8% of Abelcom's exports into the United States since 2020 were to Supermicro, and 99.7%, or virtually 100%, of Compuware's U.S. exports were to Supermicro. This is all according to trade records, which is public knowledge. Now, exports of Supermicro's high-tech components to Russia, yes, to Russia, have actually spiked 300% since the invasion of Ukraine. Apparently, this likely violates U.S. export bans, according to our review of more than 45,000 import and export transactions. Now, I don't care what you think about the war in Russia or Ukraine, but laws are laws. And if you had a president that actually had a pulse and a vice president that wasn't campaigning, well, maybe a company like this would actually have somebody going after it. But here in the United States, there's literally nobody running the country. But if you were of the opinion that Russia should not be invading Ukraine, or that is a violation of Ukraine's sovereignty, well, Supermicro is violating all types of things and aiding and abetting the country of Russia by shipping more and more units into that. So some of the revenue growth that Supermicro has experienced, particularly over the past year or two, could be directly related to Russia not being able to buy supplies and computer equipment from anybody other than crooked executives who feel like selling them the materials. Now, further investigation, this is probably the most damning thing that Hindenburg Research found out, other than that Supermicro is aiding and abetting war criminals. They're also aiding and abetting family members to enrich themselves. This is also interesting. They talked to employees and executives at CoreWeave, Tesla, Amazon, DigitalOcean, Genesis Cloud, and GMI Cloud, and all of them said that SMCI has absolutely terrible post support. Many of the servers that they get from SMCI either don't work or have firmware issues, and all of them have left SMCI after technology issues. In fact, SMCI on a recent conference call said that they are underpenetrated at the hyperscale level. That would be Amazon, Microsoft, and those types of customers. That is because the hyperscalers have tried SMCI, and not only is the stock $150 trash, but SMCI's products are $150 trash. Now, you could have saved yourself doing mountains of research talking to suppliers, talking to former employees, doing Google Earth images searches of where the executives and the headquarters of related parties happen to be. Doing all of this research, folks, you could have saved yourself all of this time and looking into this company, which has a history of not doing things properly from an SEC perspective and being delisted from the NASDAQ. You could have saved yourself all of that time and did what I did 4 months ago and said, let me just pull up this company's publicly reported financials. And this is when the stock was at $800. And I urge you to go back to CNBC and go back to look at YouTube and find all these freaking dorks that don't really know anything about making money in the stock market and probably haven't made a nickel in a long time in the stock market. They were telling you, oh, super microcomputer, this is like a derivative of Nvidia, even though Nvidia is like less than a 1% customer of this. And Jensen Huang has recently said that he'd rather build his servers over at Dell, which we'll talk about in a minute, that reported earnings. You could have saved yourself a lot of time because numbers speak louder than words, oftentimes in the financial markets. We'll see a similar thing when we talk about Intel here in a second. All of the things that are coming to light this week with Intel divesting or wanting to split off their foundry business, it was all staring you in the face if you knew how to just read basic financial documents. We're not even talking about financial documents don't get to a high level. They're all very, very, very basic. And it was very basic just a couple of months ago on the year ended of June 30th for Super Microcomputer. After having one of the best years from a revenue perspective, a revenue growth perspective for this company, the net cash that was provided by operating Super Microcomputer during the fiscal year of 2024, which ended in June of this year, was a negative. Again, I'll remind you, this is after Super Microcomputer had one of the best years from a revenue perspective, from a hype perspective. That's probably maybe even more important. All the coverage that they get for free on CNBC, all the coverage that they get for free on Twitter, all of the coverage that they get for free of these idiots pumping this stuff here on YouTube. This company couldn't have had a better year from a hype and a revenue perspective. But operating the business, I just showed you this as it related to Nvidia. Just over the past 6 months, operating Nvidia, they printed $29 billion. Even before all of the AI hype last year, they printed $9 billion. This year, obviously, $29 billion. That's fantastic. And that's the reason why shares of Nvidia continue to go higher. But Super Microcomputer lost $2.5 billion of cash operating their business. Now, some of it has to do with inventory, that they've built up a lot of inventory and they've had to scale up their operations. Well, we just learned from Hindenburg, where are they using that money to scale up the inventory? Oh, well, they're buying from their brothers. They're buying from companies that are owned by the husband and the wife. So the company literally doesn't care if it's burning through $2.5 billion operating the business, because this $2.5 billion goes to companies that are also owned by the Super Microcomputer family and the CEO and the wife himself. This company is an absolute disaster. I said it's $150 trash. If it gets to $150, we'll have to analyze it then. But until then, you should have nothing to do with Super Microcomputer. If you bought these shares at a higher price, you need to check your pulse, and you might need to check yourself into a financial institutional hospital, because there was nothing, absolutely nothing in Supermicro's financials that said this stock was a buy at a higher price. In fact, based on the information that we know now financially and also fundamentally, based on all of this information, there is nothing to convince me to buy Super Microcomputer at a lower price. This is a garbage company run by crooked CEOs and a crooked family, and these people belong in jail, particularly as it relates to funneling Supermicro's equipment to the country of Russia in a time of war and a time of sanctions on that country. Again, I don't care which side you fall on in terms of who you're rooting for when it's Russia versus Ukraine. But the bottom line is if you're operating and you're listed here in the United States, we have export restrictions and laws that companies are not allowed to do this. But by all accounts, Supermicro is ignoring that. And a lot of the revenue growth that you've seen over the past year looks like it's probably not only illegal, but it also sends money back to subsidiaries that are controlled by the CEO, his family, and his wife. This is $150 trash, and in some ways, this is $0 trash. Now, who does it benefit? Probably Dell Technologies, folks. Over the last year, shares of Dell are up 100%. Year to date, you're up 51% over the past 6 months, while Supermicro shares, I think, are down to 50%. You're up 22%. Even over the past month, you're holding up with Dell. We'll look at this technically as well. After reporting earnings this week, shares of Dell Computer up over 2%. The company reported earnings, $25 billion. That was a solid 9% growth year over year. They beat expectations by about $910 million. They obviously are experiencing massive growth in servers and networking. And the Hindenburg report noted that a lot of key customers, as it related to SMCI, have tried them and then noticed that this company's products more or less suck. And then even maybe more importantly than that, after you try to approach Supermicro, after you get delivered the product and you try to get them to fix it, this company doesn't do it because they literally don't care. And so a lot of people are moving over to Dell, and I think they probably got a good backlog of business that they're generating. 80% growth in servers and technologies over the last year, from 4.2 to 7.6, with SMCI continuing to fall on its sword. And again, if you had a federal government that actually had a president that had a pulse, well, this company would probably be liable criminally. And so Dell would probably be even in a better position in some cases. But you see total year over year growth in terms of storage and all revenue up about 38% because they do have the storage business, which is more or less down year over year. Now, the company is doing a pretty decent job financially. Total revenue has gone from $23 billion up to $25 billion. This is not a mega high margin business. We see this with the SMCI and all these kind of component manufacturers or contract manufacturers. You see off the product revenue of about $19 billion, you have $16 billion in cost. The services business is obviously much higher margin. So your gross margins over the last year, despite much, much higher server and networking revenue, despite 9% revenue growth, you actually see gross margins over the last year decline from 5.4 down to 5.3. That is the problem with this business. It's not Nvidia. It's not even AMD in a lot of ways. These businesses not nearly as good. So this is another reason why we called SMCI $150 trash, is because the business economics of these contract manufacturers it is not nearly as good, obviously, as the source of the designs. But Dell has done a nice job. Year over year, they've knocked down their selling general administrative costs. Again, despite higher sales and revenue, they went from 3.5 down to 3.2 on that. They controlled research and development costs up 11%. Look at your total operating expenses year over year, down 6%, which is exactly what you want to see when your margins compress. So the company's operating income, despite lower gross margins, they shave some expenses out of the operating side, 15% growth. This is actually really good. The CFO of Dell is doing a very, very nice job because they grew revenues by 9%. Their margins compressed, but their operating income went up 15%. Now, we sympathize. There were probably people at Dell that lost their job or didn't get a big pay raise or something like that. But from an investor standpoint, look, this is not a charity here. We have to invest in these companies. We have to make money, and that's what we have to care about. You went from 1.1 up to 1.4. More or less on the 6 months, you're seeing a similar story, but this quarter, in my opinion, was particularly good from a financial perspective. Now, from a cash perspective, they're not flush. They're not absolutely flush with cash. They do have some inventory sitting on the books. They've got some receivables as well. So those are good things. Those should be recognized as profits, but they do have a fair amount of long-term debt still sitting on the balance sheet. They've got some short-term debt here due as well. When you come down here to the cash flow statement, you see that the company generated far less operating cash flow, although a lot better than what SMCI is doing. For the last 3 months, you generated $1.3 billion. Last year was much, much better at 3.2. But they don't have a lot of expenses. They don't have a lot of expenses. They're not building a lot of capital expenditures, only $682 million. So what it's allowed them to do is repayments of debt. Now they did issue some more debt. So in a lower interest rate environment should help a company like Dell, which operates at relatively low product gross margins. Well, it's going to allow them to continue to kind of borrow that money, pay off that long-term debt. If they can improve their operating cash flow, those things can get better. They did buy back some stock over the past 3 months to the tune of $725 million. I don't know if they necessarily need to be doing that. Probably repaying this debt is a good idea. When interest rates continue to go lower, I think we'll get probably close to zero at some point. Well, it certainly will benefit them. Now, moving over to another company, which I have absolutely crushed numerous times. In fact, I'm known for calling the firing of the CEO more than on one occasion. Over the past year, shares of Intel as a semiconductor business has absolutely been skyrocketing. Intel is down 36%. Over the past 5 years, you're down 53%. Over the past 10 years, you could have put your money under the mattress and you would have made more money than putting your money in Intel stock. And over the past, long time, since 1994, and I say you're just up 440%. If you had put your money in just about anything in 1994, even like a gold coin, I think you'd be up a heck of a lot more than 440%. But are better days ahead for Intel as the company is finally wising up and realizing that the foundry business that everybody thinks is a good idea is actually a bad idea. As red ink, which is losses on the balance sheet, continue to mount, the company is making some hard decisions. Now, the fact that Intel is finally making these hard decisions comes at absolutely no shock to me, and it should come as no shock to you. If you're one of the people that got into my comments so many times that, the foundry business is what's going to help Intel turn around, or, just wait until, I can't tell you how many times I heard the Intel company line. Literally, you guys heard what Pat Gelsinger said, or somebody on CNBC that was trying to pump Intel stock. You took the company line that the foundry business what was going to turn this company around, and you would repeat it to me. You would come to me and say, well, no, the foundry business should not get split off because that's what's going to help turn this company around. And I would say, no. And here's the proof of that. Here's the absolute proof. You didn't need for me to tell you this. This has been in these financial documents for over a year, 2 years now. Here's the Intel Foundry business revenue. Come down to the segment revenue when they report their earnings, a little bit lower. Now you have to get past the press release. I know a lot of people just read the press release and they read the top line and then they go to their favorite YouTuber and the YouTuber basically repeats all of everything that the CEO said. Stop doing that. Stop doing it. There's a reason why if you do that and you lose money, it's your fault. Stop listening to these people. Come to the segment results and look at the results for yourself. Here's the Intel Foundry business. On a 3-month basis ending in July, last year they did $4.2 billion in revenue. This year up a little bit to 4.3. So revenue is increasing there. That's probably a good sign. But what's not a good sign is you come down here to segment operating income, or unfortunately, if it's in parentheses, that is a loss. That is actually a negative number. Here's your Intel Foundry business down here. Last year on $4.1 billion in revenue, you lost $1.9 billion. Folks, that's nearly negative 50% gross margins. The reason why Intel's foundry business actually gets any business is they're literally giving away the service for free. Now, as we noted, the company actually had an increase in revenue over the past year from 4.2 up to $4.32 billion. But sadly for Intel and its shareholders and its fanboys, the Intel Foundry business lost nearly $1 billion more. So yes, on higher revenue year over year, and after higher pumping and higher government subsidies and everybody saying that the foundry business is what's going to save this company, well, on higher revenue, you actually lost even more money. From $1.8 billion, now you lost $2.8 billion. And the reason why, folks, that is a problem for this company is through 6 months ended. Now, I've showed you several companies on today's show. I showed you Nvidia through 6 months ended operating cash flows over at Nvidia We're $29 billion. There's only, I would say, probably 4 or 5 companies in the world, maybe only 3 actually, that are doing numbers like this or better than this. So this is clearly the creme de la creme. We looked at Super Microcomputer. This is the trash of the trash. In a year where your business was supposed to be red hot, you lost $2.5 billion. Somewhere in the middle there, Dell Computer. This is Dell. Over the past 6 months, the company generated $2.3 billion of operating cash flow, and they're not making the stupid mistake of trying to build foundries, so they don't have nearly enough money to spend on that. But unfortunately, Intel is not in that boat. For the last 6 months, Intel, like I said, Nvidia did $29 billion in operating cash flow. For a full year, SMCI dusted off $2.5 billion. Dell squeaked out $2.4 billion. That's a positive number. For Intel, they squeaked out just $1 billion. We'll give them credit for $1.1 billion. And the problem is, folks, they're trying to build these foundries. And yes, they are getting some government subsidies to the tune of a lot of money, but nothing offsets the $11 billion of addition to property, plant, and equipment. And this is going to a business. So I'll repeat, $1 billion of operating cash flow, $11 billion to build the property, plant, and equipment to this foundry business, which on just slightly higher revenue, lost nearly $1 billion more. Finally, Pat Gelsinger is waking up. He's listening to, I suppose, Morgan Stanley and Goldman Sachs. I have to expect there's got to be a desk over at Morgan Stanley and Goldman Sachs waiting for me, as we have identified the shortfalls in Intel months ago, and in fact, years ago for Intel. And if the company addressed the situation then, the shares would probably be epically much, much higher at this point. But now addressing these issues could be too little too late, but it is a good sign that Intel is finally addressing the underlying problems, which again, we've identified many, many times here on the channel. Now, let's go to the technical segment. The SOXX ETF looking good. We're right here at a resistance point. This is why we divide these channels in half. I tend to do it in a light green line. You could buy the SOXX here with the idea that you're going to push higher. You've got earnings from Broadcom next week. I don't think we've got any other major semiconductor companies reporting, so I'm not exactly sure what will push this thing higher. I think greater clarity on where Nvidia is going to fall in these revenue estimates, which we talked about at the jump of this thing, that will help drive the stock, or the SOXX ETF actually, and the SMH either higher or lower. But we've got to wait on clarity there. Moves higher should probably be sold, at least portions of it, as profits. Moves lower, particularly you get back down here to, call it maybe 215 or so, can be bought. The SMCH, the SMH, I'm thinking about SMCI. We've got the SMH ETF, also very popular ETF. Closer to the top of the range, wouldn't really want to buy it here. You move up into the 280s, 290s. That's a chance to take some profits. Pullbacks obviously should be bought. Now, I bought Nvidia this week, not technically. There is technically, if you want to take off some lines here, if we want to, and just focus on maybe like that trend right there, should have some support for the shares down here at 110-ish. In fact, in the after hours, I think that's maybe a number I got this one a little closer to. I actually bought this one in the after hours on that kind of knee-jerk reaction after earnings. I didn't buy this technically. I only bought it because exactly what I described in the beginning. The discrepancy in the gap in this company's revenue estimates is so wide that there's going to be some great volatility here, and great volatility either leads to much greater prices higher or lower. Your stop loss on Nvidia is 2 different areas. $90, $89 would be somewhat conservative. You are risking $30 to the downside. So if you don't want to do that, a stop loss at 105 or so, risk 15 to set a new high, probably back in the 150s. So you're risking 10, 15 to make like 30 or 40. A little more conservative or a little more aggressive stop loss, probably down here at 75. You would not want to see Nvidia get below 75. You get below 75, it brings in this consolidation down here, kind of 30 to 40. That would be a moment where you're probably aggressively buying. But again, at that moment, you get down to 30 or 40. we are not hitting $56 billion in revenue in Q3 next year. We're hitting 30. So we'll see which side NVIDIA gets to. Now, AMD has confirmed kind of another lower high. Should have some support for shares here. I've got a purple line that is loosely the trend. I have it extending all the way back to 2016, but you really could just kind of look at this one this way. And this purple line has actually held pretty firm over the past. This is like a 2-year uptrend. So an area like you can, I think Monday is a holiday in the stock market. So Tuesday, you could buy AMD if you wanted to. Now, Broadcom reports earnings. In fact, I got to switch this to a daily view. We have most of these in a weekly view. I'll probably switch back. But Broadcom reports their earnings on Thursday. So we'll certainly recap them on next week's show. I'll also likely do on the main channel just kind of a standalone earnings video in terms of Broadcom. Very similar place to NVIDIA. It's at the top of the channel, which is typically not where you want to buy this one. But Broadcom's got a diversified business. They've rolled up VMware. They've had other businesses that they bought in the past on the software side that they've got in there. Marvell reported earnings as well that were much better than expected. Shares of Marvell, I think, were up 9% on a single day. So it's possible that that networking business is just absolutely hovering along. Wouldn't surprise me if Broadcom posts good earnings and maybe retest a high up here at 186. Pullbacks in Broadcom, which we'll talk about on next week's show, probably can be bought. Intel is finding support at a logical level. Again, fundamentally, this company is a disaster. Now, I do like what they're doing fundamentally. They're finally making some tough decisions, which, they should have made a year or two ago. These decisions were staring them in the face a year or two ago. But look, it's tough to make these decisions when you're in the moment, when you're at these companies. It's easier for me to sit here as a non-biased observer of the company and tell the company what it needs to be done. Much harder to be Pat Gelsinger and actually have to make the decisions and be the board of directors and have to make the decisions. So the company is making those decisions. A logical level technically is right in 20. You've got a huge gap in the chart that could take you from 22 to 30 on this one. So don't slide in my DMs or my comments and be like, this one went from 20 to 30. Yes, technically it can do that. But if you're trading this stock, you should really only be looking at the chart. And if you're only looking at the chart of Intel and not the fundamentals, well, it probably can be bought. Qualcomm just confirmed a new higher high. So this is actually really good for Qualcomm. You're actually looking to buy the dip on Qualcomm. You can probably divide. I don't have the full channel on here, but you've probably got an area right somewhere in here that you can buy this one. So we're pretty close on Qualcomm. I'll certainly alert you here on the show. I think anywhere south of probably 150, you're definitely looking to buy that one. TSM also just confirmed a new higher high. That's very bullish for TSM, as I think they're continuing to raise prices on customers like NVIDIA, which obviously they can do and NVIDIA can afford. Pullbacks in TSM, needless to say, can be bought. ASML just got a bounce off the middle of their channel, long-term channel that they've been in for well north of a decade. In fact, you're looking at like a 2-decade-long upward channel on this one. Not be an area I'd be wildly excited, but any pullbacks in ASML can be bought. NXP looks really, really good, just continuing to churn higher on this one. And look at this chart pattern right here. I mean, good Lord, you could just be trading this to the dollar. Now, you're kind of in the middle of it, but this is just a beautiful up and down pattern. This is, I mean, oh my God, that just makes me smile. Now, ARM Holdings did find some support. It's slipped out of, I've got like a purple line on here. I would say maybe even that's the upper channel. I don't really know. Not a lot of data here. You probably could put this on a daily view or even like a 30-minute view, get some more candles on this one. But this one's looking pretty good. You'd want to see it make a new higher high. So technically you could buy this one with the hopes you make a new higher high, probably back up into the 200s. Stop losses at 99, maybe even a little higher at 117 should be in place. SMCI, we called it $150 trash. I'll show you technically what that would look like. It would actually just take you back to trend on SMCI. This green line, which I'll change to a Kobe Bryant shade of purple, this is the trend with SMCI. This like over exuberance, this gigantic burst in the share price, this is all hype. None of it is supported by financials. The company is losing money. The company has a history of fraud and SEC violation. The company is funneling money to insiders and company executives. This is all obvious from a report that we got again from Hindenburg Research, which I'll link down in the description below. All of this is obvious. All of this is hype. All of this is idiot, moronic retail investors. This is what drives it right here. Yes, you have some institutional buying of this to a certain degree, but a lot of this are just a bunch of idiots that don't know how to read a financial report and don't know how to read an operating cash flow statement. You have some consolidation down here at SMCI. This is where it's going very soon. Probably by the end of the year, you're back down here at 250 to 300 on this level. When this level, and notice I said when this level doesn't hold, you'll come back down to the 150 level, which will take you back down to trend. And that's when you evaluate once the CEO is out, once they've made some changes over at SMCI, maybe it's a buy. But again, these contract manufacturers, when you're looking at Dell, not wildly profitable. You'd probably rather have your dollar in another area of the semiconductor industry. Dell's looking okay. It's weird technically. We only go back to 2019 on this one. I don't know technically from Dell, but fundamentally SMCI falling on its face, the anecdotal evidence from the Hindenburg Research, from Tesla, from all, I showed you all of these supplier. They literally have quotes from people from these companies: CoreWeave, Tesla, Amazon, DigitalOcean, Genesis Cloud, GMI Cloud. There was a few others. Like, they hate working with SMCI. And my guess is all of these companies are not going to go back and do business with them. So Dell should be able to pick up some of that business. Get a lot of questions on Micron. Micron's a light buy at this level. You have this nearly decade, actually longer than a decade long trend in this one. When you get to the middle of these channels, I put a light green line. It's a light buy. You want 10 shares of Micron, 2 shares at this level, 3 shares. If it goes lower, you buy 6, 7, 8, you get up to that 10 share mark. If it moves higher, you probably could, turn that into kind of a shorter term trade if you want, or just wait for another pullback. But Micron at this level can be bought. We got Lam Research. This is a buy. This was a buy. I think we actually pointed that out. I hope we did. This is a buy based on the long-term trend. You can log in on Tuesday if you want and buy this one. Your stop loss should be on this low right here at about 723. So you're risking 100 to the downside to make a new high probably to 1100. So this is a 3-to-1 risk reward. This is the type of trade setup that you're looking for. Okay. You're risking $100 to the downside. Again, this is per share. So if you bought 1 share, you would lose 100. If you bought 10 shares, you'd lose about $1,000. But with the upside back to a higher high, or at least re-meeting the highs up here, this is a 3-to-1, 100 to the downside, 300 to the upside. Maybe that's less than 3-to-1. I don't know. My math isn't great. I've been studying for the Series 65 all week, so I've got discounted cash flows and tax equivalent return formulas in my head. Other math maybe going to have to be on the wayside. Applied Materials, AMAT, probably also a buy, not as strong as Lam Research, but this one also kind of touching or just above kind of a longer term trend, looking like it maybe wants to make a new high up here at about, we'll call it 270. So you've got $80 to the upside. I'd want to have a stop loss on this one. Actually, it'd probably be pretty lower. So your risk reward have to be spread out on this one. 60 to the downside to make 80. It's not great, but there's other setups here, which I showed you, that are certainly better from a risk reward perspective. Folks, that was the Semiconductor Show. I'll probably try to do these on Saturdays because we've got NFL football starting here very soon. I'm going to try to record these Saturday morning so I can sit on my butt the rest of the day and watch college football. Hopefully you guys have a long and safe weekend. Happy Labor Day. Hopefully you have some time to spend with the family and the kids if you got any. And we'll see you again next week. Thanks for tuning in. Like, subscribe, share the video. Your support means a lot. Thanks. I'll see you soon.